Financial statement analysis. Now in today's class, let us start discussing financial statement analysis. Before going to understand and start analyzing financial statements, it's always best to know what are the financial statements and what information we are provided. Financial statements are: Number 1. Balance sheet. Number 2. Income statement. Number 3. Statement of cash flows. Number 4. Statement of comprehensive income. Number 5. Statement of changes of stockholders' equity. Number 1. Balance sheet. Reports the financial position of an entity at a point in time. Number 2. Income statement. Reports financial performance of an entity over some time via accrual accounting. Presents the results of operations, revenues and gains less expenses, losses and taxes for an organization over a period of time. Number 3. Cash flow statement. Reports financial performance via cash flows of an entity. Presents the change in cash and cash equivalents classified as either operation, investing, or financing. Number 4. Comprehensive income. Includes all changes in equity during a period except those resulting from investments by owners and distribution to owners. Comprehensive income is equal to net income plus other comprehensive income. Number 5. Statement of stockholders' equity. Shows the changes in the capital received include issuance and repurchase of shares, and retained earnings include net income and dividends for a period. Notes to the financial statements. Included as an integral part of the financial statements to identify and describe accounting principles and methods, recognition criteria, measurement basis. It contains all other information relevant to users and discloses facts not presented in either the body of the financial statements or in the summary of significant accounting policies. Financial statements must read with notes, otherwise it has no meaning. Now let us start understanding the income statement and balance sheet items. Income statement reports the financial performance of an entity over a period of time via accrual accounting. Presents the result of operations, revenues and gains less expenses, losses and taxes for an organization over a period of time. Balance sheet reports the financial position of an entity at a point in time. Let us start talking about an individual basis who has an income or salary income of $100,000. It seems a very good salary. Per month average, they are drawing $8,300. So we can now conclude that this individual is well paid. He is doing very well. This income which he earned during a period of time is carried forward into the balance sheet in the form of retained earnings, along with any other capital which he might have had previously. Now let us assume he didn't have any capital, and let us carry forward these retained earnings until the balance sheet that forms equity. Equity comes under the balance sheet liabilities side. The balance sheet equation would be assets is equal to liabilities plus equity. Equity contains the shareholders' capital, reconciliation of retained earnings, and reconciliation of carrying amount of each class of equity capital, paid in capital, and accumulated other comprehensive income. Once these retained earnings are on the balance sheet, how did he use this? Is it in the form of cash? Is it in a form of an asset? If it is in the form of a long-term asset or a short-term asset, all that becomes quite evident in the balance. For example, let us assume that he had an initial capital of $1 million and the salary income of $100,000, totaling $1.1 million equity. Now let us know under the asset side what kind of items would come. For example, under the asset side, it shows the Ferrari long-term asset. Holding a long-term asset, one cannot manage his day-to-day expenses. By looking at the balance sheet, assets side, a person reading would see whether he has enough liquidity or not. And when money is blocked in a long-term asset and there are no short-term assets, the liquidity is not there. Now with the same example, if I say that $1 million was invested in a Ferrari, long-term asset, and $100,000 is in cash. Now it looks like he is solvent because he has no debt and he has an asset which is long-term as well as short-term. But there is liquidity as well. But is the asset being of good quality to generate income? All that is left unanswered. Now with the same example, we'll modify it a little bit and try to understand. There is a $1.1 million as equity and $1 million as debt. On the liabilities side, you have a total of $2.1 million. If we invest in a building, long-term asset, $1 million and $1.1 million in cash, we can see that you have got enough liquidity and solvency. A company or an individual will be solvent if its assets are more than its liabilities. Fine. So in this example, he has got $2.1 million in touch and $1 million in debt is very solid. Now let us try to understand current assets and current liabilities. Current assets are assets that can be converted into cash or cash equivalents in 1 year or the operating cycle, whichever is longer. Let us understand what is operating cycle is. Operating cycle which can be converted into cash or cash equivalents. So it can be in the form of cash or the form of debt or the form of inventory or as long as it can be converted into cash in a year. What are current liabilities? Current liabilities are liabilities that have to be paid in a year or the operating cycle, whichever is longer. What are the forms of current liabilities? It can be a short-term debt or long-term debt. Current liabilities include salaries, paper taxes, etc. Looking at the balance sheet, one must understand whether are your current assets are enough or sufficient to pay off these current liabilities is what you called liquidity. There will be many other ratios to find out the liquidity, solvency, and positions of our company, which we are going to discuss and understand by practicing MCQs in our future lessons. When it comes to the income statement, you will be calculated to know operating income and the non-operating income by using an accrual basis of accounting. The income statement is used to measure the profitability, creditworthiness, and investment value of an entity. Operating income consists of sales, cost of goods sold, selling, and general administrative expenses, other revenues and gains and other expenses and losses, and income taxes to be considered to calculate the income from continuing operations. To calculate the net income, We will be considering the other comprehensive income after we calculate the income from continuing operations. Now let us discuss the statement of cash flows. Cash flow statement reports financial performance via cash flows of an entity, presents the change in cash and cash equivalents classified as either operation, investing, or financing. When calculating the cash flow statement, we have to eliminate all non-cash expenditures to calculate the correct cash flow. Cash is a most liquid resource, and therefore it affects liquidity, operating capability, and financial flexibility. The statement helps interested parties determine if an entity needs external financing or if it is generating sufficient positive cash flows to meet its obligations and pay dividends. A company with a high income can still have negative cash flow. A statement of cash flow must report on a company's cash inflows, cash outflows, and net change in cash from its operating, investing, and financing activities during the accounting period in a manner that reconciles the beginning and ending cash balances. Operating cash flow will be calculated under the indirect method of cash flow by adding all non-cash expenditures, that is, depreciation and amortization, etc. Cash flows from operating activities, indirect method. For particulars, net income, amount. For particulars, plus depreciation on fixed asset, amount. For particulars, plus amortization expenses, amount. For particulars, minus gain or loss on sale of fixed asset or investment, amount. For particulars, plus increase in current liabilities, amount. For particulars, plus decrease in current asset, amount. For particulars, minus increase in current asset, amount. For particulars, minus decrease in current liability, amount. Net cash flows from operating activities. Cash flows from investing activities are calculated by considering: Number 1. Purchasing and selling property, plant, and equipment, fixed assets. Number 2. Making and collecting loans to other parties. Number 3. Acquiring and disposing of available for sale or held to maturity securities. Number 4. In addition, as mentioned above, cash flows from the purchases, sales, and maturing of trading securities may be classified as investing activities if the securities are not being held for sale in the near term. Cash flow from investing activities format: plus sale of fixed asset or investment, minus purchase of fixed asset or investment. Net cash flow from investing activities. Cash flows from financing activities are calculated by considering: Number 1. Issuance of stock. Number 2. Treasury stock transactions. Number 3. Paying dividends. Note that dividends paid are a financing activity but dividends received are an operating activity. Number 4. Issuing debt, such as bonds. Number 5. Obtaining a loan and repayment of principal of the loan. Number 6. Repayment of principal on other debt obligations. Number 7. Cash flows from taxes paid and tax refunds received are classified as operating activities. Cash flows from financing activities format plus proceeds from issuing stock minus dividends on common stock minus repayment of long-term loans. Net cash flow from financing activities. Any other non-cash investing and financing activities are not included in the statement of cash flows because they are non-cash investing or financing transactions. Examples of non-cash investing and financing transactions are: Number 1. Debt converted to equity. Number 2. Borrowing money to purchase a fixed asset. When the lender pays the loan proceeds directly to the seller of the asset to make sure the loan proceeds are used as intended. Number 3. Buying or selling fixed assets for something other than cash. For example, stock. Number 4. Obtaining a building or other item by gift. Number 5. Exchanging non-cash assets or liabilities for other non-cash assets or liabilities. Now let us understand the comprehensive income. US Generally Accepted Accounting Principles (GAAP) are based on comprehensive income. Comprehensive income is the change in equity, net assets of an entity from non-owner sources that arise during a period from transactions and other events. It includes all changes in equity during a period, except those resulting from investments by owners and distributions to owners. Comprehensive income includes everything on the income statement plus some specific items that do not appear on the income statement. The items that are not considered comprehensive income. Other comprehensive income items are expressly stated in the standards. The 4 items currently in this group include: Number 1. Foreign currency translation adjustments. Number 2. Gains or losses in prior service costs or credits related to a defined benefit pension plan that has not been recognized as components of net periodic benefit cost. Number 3. Unrealized holding gains or losses on available for sale securities. Number 4. The effective portion of the gain or loss on a derivative is designated as a cash flow hedge. Note: not necessary that all companies must be having all the 4 items that we discussed just before about other comprehensive income. Now about foreign currency translation adjustments, which are very important and relevant for the CMA exam and will be discussed in detail.